Now, here and now, there's a change of season and market regime on our cross-asset model, which has just triggered a rotational unwind of risk appetite equities, case in point in corrective volatile mode, and then juxtapose gold and rates still elevated. Now, just to be more specific to US equities and S&P 500, that's already confirmed a distribution pattern, which is reversing back under a long-term rising trend. Key level there is 5,000 psychological, which the market's ebbing closer to. And the bottom line here is that there's a triple whammy of headwinds that continue to weigh in. The unwind from momentum extremes, rotation fragility, which is actually starting to play out, and the cycle risk, all warning of an impending correction in Q2 here and now.
So that triple whammy of risks is pointing to, well, obviously volatility, but volatility and an obvious downward correction, or is it not that obvious yet?
So it's obvious in the sense that we will likely get a minimum 10% correction. We've already had half. And will likely extend lower. Overshoot risk is possible. The question now is whether we get a hard and fast move now or later on in the year. The best guideline for this in terms of historical analog is the 2000 tech bubble. Not that it's a one-for-one comparison from a macro or even sector perspective, because this time could be different with the AI paradigm and other nuances, but specifically in terms of the corrective three-stage move that typically happens when markets are irrational and overrun for too long. So that opening chart, which I believe we have for your audience, is a three-staged corrective pattern. It's a fall, which we're witnessing right now, an oversold bounce that most people look at as a potential buy on the dip opportunity. If proven out true, then we should go back up to all-time highs. If not, then that's a long squeeze and the biggest bull trap to the downside, where we get the rest of the fall. Now, what's interesting is it also chimes in with seasonality patterns. This is the second day of May, and yes, potentially a sell in May time window where we get sideways market with elevated volatility, but also the rest of the move to the downside could typically be in September and October, and in time for the next event risk for that time of the year, US elections.
Yeah, I mean, it points to what you've just been saying as well about rotation fragility, doesn't it then, Ron? I mean, unwinding that risk appetite and a vulnerable market. Ultimately, the expectation still of a volatile market here. That's going to increase then over the coming months?
Likely, even a sideways volatile market can still be a challenging one, particularly when we've had such strong bullish sentiment. This whole idea of a behavioral inflection point, which was mostly predicated, yes, on a strong bullish consensus, but also the whole mirage of a rate normalization and potential cuts ahead. Essentially, we may still get that, but clearly consensus was likely too strong. And as we adjust, in this, behavioral inflection point, there will continue to be macro surprises. We've already had hot, sticky inflation, weaker than expected GDP, with potential other data-sensitive points to come through. The big outlier will likely be inflation, and that's in line with our long-standing view that rates and inflation will continue higher for longer.
I mean, that's just an incredible chart, actually, that we have now up, just the inflation resurgence and thinking about the 1970s here, ultimately it coming down and a resurgence ultimately still coming into play. So around 2026 and further on then, we're about to expectantly see another ramp up is ultimately what you're saying there. But if I look just with regards to equities and I stay there, if mega cap tech is in the early stages of falling from grace, as you put it, it's ultimately time to find a new market leader, isn't it?
Yes, absolutely. And for some time, we've been saying to essentially employ a barbell strategy with risk asset selectivity, so continue to make money in those strong prior trends, but take profit with downside protection, and in parallel, build up robust defensive plays such as gold, but also other commodity areas as part of a potential commodity super cycle ahead, which is going to be inflationary driven. With various other defensive plays like some cash during the near-term volatility that we may see, quality bonds and non-correlated portfolio risk, but to focus more on that inflation rolling waves of volatility ahead back into 1970s. Essentially, it's again the historical rhyme. There are some different macro differences, but the key thing is we've had rolling waves of volatility. So trying to have a target projection on rates or inflation is a fool's game, essentially, because we're going to get up and down. And just having had inflation half and now switch back into transitory mode, we could be for the third and larger wave ahead, which could commence as early as the second half of this year, with most of the move into 2025 and beyond. So yes, commodities would be an interesting place to be, which our third chart clarifies in terms of the ratio of commodities and equities.